Now, South African households ended off last year in a slightly better financial position, if you can believe it. The Altron FinTech Household Resilience Index, it's quite wordy, for Q4 of 2024, confirming an improvement in household finances. It was mainly due to that 325 basis point cuts that we saw in the repo rate. It does make a difference, of course. One economist saying the two-pot withdrawals in the fourth quarter also did provide something of a boost.
The Altron FinTech Index of financial resilience of your average South African household has received a welcome boost, but unfortunately, it's not necessarily to the long-term advantage of households because it is related to the two-pot system and the withdrawals from pension funds and other long-term investments. If one excludes those indicators from the index is still up by 1.4% year on year. So there is an improvement. And this is obviously related to the 3 interest rate cuts that we've had. But they have not been sufficient to prevent people from dipping into their savings.
You want to prevent people dipping into the savings. That's the real issue in getting themselves into debt. Well, this index also shows that although the ratio of household debt costs to disposable income has declined to 8.9%, it does remain very high considering the 6.8% levels in 2021.
Because of the restrictive monetary policy that we've had for a very long period of time, more than 3 years, the Reserve Bank is of the opinion that it has the lowering of inflation has not come at a cost to the economy. But I believe they're wrong because your real disposable household income in this country per capita has declined, and especially since this move to the highest interest rates that we've had in 15 years, at a time when the South African economy is hardly growing. It does not make much sense to me. We need lower rates desperately in South Africa to get the economy growing, to create jobs, and obviously also to relieve the financial pressure of households.